Welcome to our weekly global macroeconomic roundup, where we break down the most important economic news and trends. Starting with the United States, let's look at the latest economic performance and policy moves. The IMF warns that America's $39 trillion debt has become a global systemic risk, eroding the safe haven status of treasuries, lifting global borrowing costs, and raising fears, echoed by figures like Henry Paulson, about weakening long-term demand, especially as China pulls back. Geopolitical tensions, including disruptions in the Strait of Hormuz, are pushing energy prices higher and weighing on business sentiment and industrial output. While parts of the U.S. economy remain resilient, broader price pressures, tighter financial conditions, falling home sales, labor market softening, and structural housing shortages point to rising domestic fragility. Together, these dynamics reinforce IMF concerns that global growth could shift toward a significantly weaker path if current risks persist.
Markets reacted to the signals with volatility, a critical driver of global economic equity indices adjusted
China's
based on the
outlook is
outlook for
stabilizing
future Fed
as
action.
policymakers manage both external pressures and domestic restructuring, pushing back against rising EU protectionism while navigating trade tensions linked to excess exports and earlier U.S. actions. At home, Beijing appears to have deflated its property bubble in a controlled manner, prices down 40 to 50% since 2021, avoiding systemic fallout and enabling a shift toward more sustainable, higher quality growth. Recent data, including GDP growth near 5%, highlights resilience, supported by strategic crude stockpiling that has cushioned the economy from Middle East-driven energy shocks. Still, policy space is narrowing. The PBOC is expected to hold rates steady as higher oil prices lift inflation expectations, even as weak property activity and subdued household borrowing persist. Measures to expand foreign bank lending and strong momentum in tourism, on track to make China the world's top travel market, underscore evolving growth drivers, though declining exports and lingering real estate softness show the recovery remains uneven.
Shifting focus to Europe, let's analyze the economic landscape across the Eurozone.
Rising energy costs tied to the Iran conflict are nudging European inflation higher, with France, Spain, and the broader Eurozone all seeing modest upward revisions to around 2.6%. ECB officials, including Christine Lagarde and Modest Mueller, are urging vigilance, but warn against tightening too soon, as growth remains fragile. Governments are deploying targeted fiscal measures, such as Germany's €1.6 billion fuel relief package, while still contending with deeper structural issues, like weak industrial competitiveness and limited fiscal space. Geopolitical uncertainty is also reshaping capital flows, including increased Middle Eastern interest in European real estate, amid expectations that a US-Iran peace deal could take months. Overall, the Eurozone sits in a delicate middle ground of moderate inflation pressures, cautious monetary policy, softening investor confidence, and constrained fiscal capacity.
Across the Channel, the United Kingdom faced its own set of economic challenges this week.
The Bank of England is expected to hold interest rates steady through 2026, despite inflation rising toward roughly 3.3% due to the Iran-related energy shock, with only limited easing projected for 2027. Policymakers face a difficult balance as fiscal pressures intensify, with Chancellor Rachel Reeves signaling potential spending cuts to fund higher defense commitments while avoiding tax increases or additional borrowing. Market sentiment is weakening sharply. UK power stocks are falling amid proposed electricity market reforms, and business confidence has dropped to near pandemic-era lows, while structural and financial stability concerns are growing, prompting the central bank to incorporate artificial intelligence into stress testing frameworks. Political strains around governance and efforts to deepen regulatory alignment with the European Union add to the uncertainty, leaving the UK economy navigating a fragile mix of inflation pressures, soft confidence, fiscal restraint, and geopolitical risk.
Now, let's examine the macroeconomic environment in Canada.
Canada is in a comparatively strong fiscal position among advanced economies, what the IMF calls the cleanest dirty shirt, even as policymakers work to reduce external risks, including Trade Minister Dominic LeBlanc's push for a deeper U.S. trade agreement ahead of the USMCA review. At home, major banks like RBC and Scotiabank are retreating from climate-linked lending targets, while regulators intensify oversight of non-bank financial exposures. Elevated oil prices tied to the Iran conflict are boosting energy sector cash flow, though producers remain focused on balance sheet strength and shareholder returns rather than expanding output. Against this backdrop, Tiff Macklem has emphasized that differing levels of economic slack and inflation across countries will lead to divergent central bank paths, underscoring Canada's relatively stable but cautious macroeconomic footing.
Employment figures
we
conclude our
release
regional roundup
showing
with
labor
Japan,
market
strength, while initial estimates for quarterly GDP growth provided insight into overall economic momentum.
Japan's outlook is becoming more finely balanced as inflation and currency pressures evolve, with the IMF urging the Bank of Japan to lift rates gradually while staying data-dependent. The yen remains weak, near 160 per dollar, prompting officials to signal possible FX intervention, though Governor Ueda has avoided committing to near-term hikes. At the same time, the BOJ is considering raising its inflation expectations, reflecting growing confidence in more durable price pressures, even as policymakers weigh the risks of tightening too quickly against continued currency weakness. In conclusion, the global economic narrative remains that of uncertainty, fostering stagflation risk. If you love contents like this, please like, share, and subscribe to this channel.